these are dangerous times, risky times,
Yeah, I think
unprecedented times.
Warren Buffett also said that first rule, don't lose money. Second rule, don't forget the first rule.
That's exactly. I paraphrase Mr. Buffett's famous rules.
I am very curious. What have you discussed with Harry Markowitz a few years ago, as you mentioned in a podcast, the founder of modern portfolio theory?
Yeah, very impressive guy and a very down-to-earth individual. We had him at a study group meeting in California. Somebody asked him, never thought he'd accept it, but he did. And we had this genius with us for a whole hour asking him questions. And on the one I was most interested in asking him was, what is your allocation, sir? What kind of and he just said 50-50, 50% stocks, 50% bonds, which I thought, and later on, my research validated as if he needed validation, exactly what he had adopted for his personal use. So that was quite an extraordinary experience. And not every day you get to sit across the table from a Nobel Prize laureate.
I think even John Bogle said if you have 50% in equities and 50% in bonds, you think every day that you might have too much in stocks or too much in bonds. So it's a good compromise after all.
Yes, but now I'm 20% stocks, 20% bonds, because I think we're kind of in a unique circumstance where everything is overvalued. And
you are more, let's say, in Howard Marks camp, who says move 50, forward, 50. But with caution. But there are other advisors in this environment who say the following: because expected returns are lower, we need to take on more risk to get the same returns as before and to be able to fund our retirement. Thinking about that, we cannot predict market downturns, and that all that we know is that future prospective returns are lower. So this is all we know, and therefore you cannot afford to be 50% right now in equities. You need at least 75% in the new normal so that you can get what you need, because bonds and cash offer negative real returns. What do you think about this approach?
Yeah, I'm going to paraphrase an old statement I heard about pilots. There are old investors and there are bold investors, but there are no old, bold investors. Sooner or later, if you take a lot of risk and do it consistently over a period of time, you're going to get hurt badly. So I don't think the markets rarely provide us with what we want or say we need at the time we need it. You have to accept whatever the markets are prepared to give you in any circumstance and be satisfied with it. And markets fluctuate. There will be times when the markets will offer you a much better deal. Just hang around, preserve your capital, and wait for those opportunities. I think you do much better off than assuming that the market is, just because you're getting aggressive, it's going to support your intentions. That's a short way to bankruptcy.
Yeah, so basically, in this environment, you don't think that the time horizon would save you, right? I mean, if the downturn comes, it will come for everybody, and you will still lose money no matter that you are young or old.
Yeah, the old can afford to, because they're buying stuff as it goes down in price. The young and the older, can't replace that capital, so they have to be very, very careful with it. This is a whole different market than we had 30, 35 years ago and beyond. It's because you got third parties like the central banks getting involved trying to manipulate markets, and you've got high frequency trading, which is causing things to happen very quickly. Remarkable, that bare little month and a half we had in early 2020 from the COVID went 35% in a month and a half. It was over, and then the market goes up 80 and 100% after that.
Crazy.
This is nuts. This has never happened before. So we know we're really in a completely different environment than we were. And if you get another big bear market, it could happen very, very quickly, again. So you got to be careful.
As I said in the beginning, today was like Black Monday. I mean, I looked at my stock positions and everything went down like 5% in a day. And I was thinking, what the hell happened today? I mean, very fast decline in one single day. I mean,
that's the nature of the markets today. There are so many different factors it'll go down very fast. And if you didn't prepare your portfolio for that, you may not be able to, squeeze through that exit door.
I have a question for you, Bill Bengen. There are those famous studies that if you lose, let's say, the best 20 trading days for S&P 500, that will affect all the historical or almost all. So
sure.
Those people say you have to stay timing the market is better than timing the market, because if you waste those best trading days, you will ruin all your returns. What do you think?
Well, I think that's accurate as far as it goes. In fact, a gentleman I know who's a highly regarded researcher wrote an article to that effect on some investor website and made that exact statement, because he's very anti-market timing. And I wrote him and I said, okay, I understand your point about losing so much return if you miss the 20 best days. But what do you gain if you miss the 20 worst days? And he wrote back and said, I haven't calculated that. So, I'd like to have a more even-handed approach. I'd like to know both, numbers. It's true that if you miss the 20 worst days, but if you have a proper system of risk management, I think you'll still be okay. You'll still get most of those best days under your belt and avoid most of the worst days.
So basically, Bill, you said you had 10% equities before the March crash.
Oh yeah, and I raised it as the market came down. I buy because I can get things. When a market actually bottomed, I think it was a tape of 21, and I saw that day, and I think I added 10% to my stock allocation one day. Very rare to me something that dramatic. Turned out to be great. That did well, but I never ever got it up to the 50 or 60% that I normally would like to have had, because it all happened so quickly once again.
I'm very curious, which is your strategy right now for getting to the market again? Do you use a discretionary or non-discretionary rule? Do you look at valuations of, let's say, wait for a certain market crash like 20%, 30% before deploying money? Which is the plan?
I rely heavily on a third-party service who has had a great track record for over 40 years. They got people out of the market in 87, and they got them greatly reduced in 2000. They just been able to avoid most of the big market declines. And they use a combination of technical factors and market valuations. And they have a vast library of market data, which they refer to. They're the patterns. So it's a hybrid method, and it's been very successful. And I let them guide me because I made a mistake back in 2008. Remember that first week in October, I got out my clients 100% out of stocks, and it was great because they didn't get smashed in October, November, and they didn't get smashed in January, February. But I, at that time, did not have a strategy to exit, which is, in hindsight, was a big mistake. So I took too long to get back in, and the advantages we gained in 2008, I gave up in 2009 and 2010. I learned from that experience, and I want to make sure not only do I have an exit strategy, but I have a re-entry strategy. Both are required, and they have to be based on sound principles. And that's why I use the outside service, because they do both.
Do you have the number for these guys providing this service?
Well, yeah, the name of this, if you want me to give you the name of the service, sure. They're called Investech, Investech. Their principal is Jim Stack. He's very well known in the investment community. They're based in Montana. They're about as far away from Wall Street as you can imagine, Whitefish, Montana. And he's been doing this for many, many years. And it's just very impressive to read their research and their profound knowledge of stock market patterns. And they got a system that works. It works. They're not trying to catch tops and bottoms. They're just trying to reduce risk at a time when the risk looks high, and then increase risk when it looks like the rewards are potentially there.
So invest tech?
Yeah, INVESTECH. Right now, they're recommending just about 70% of your normal asset allocation equity. So if you're going to have 50%, they'd recommend 35 now. So, and they'll reduce it a lot lower than that if circumstances, justify.
Is this approach based on academic evidence or empirical?
Combination of technical, market action, and some of their proprietary indicators had developed over time. Because a lot of the indicators that worked years ago don't work anymore. Like the advanced decline line is not a reliable thing anymore because they changed the pricing. They went from sixteenths, remember, to decimals, and that completely changed it. So he had to develop his own proprietary indicators, and he's got a canary index and a bellwether index and a whole bunch of stuff he watches. It's really fascinating. And you can see now with this action here in January how a lot of those indicators are rolling over and starting to say, hey, this is starting to become nasty here. You ought to start thinking about do something more defensively. Not a bear market call, not there yet. He moves incrementally too. He doesn't panic. He doesn't do sudden large changes. But everything does is measured and informed by his history. And it's fascinating. I think that they understand what you have to do. They're very successful.
Sounds really interesting, especially during these times.
Yeah. Oh, yeah. I think you almost need somebody like that to get the emotions out of the process, because this can be very scary for people. Very scary.
You also mentioned that you have some gold positions. Do you also own Bitcoin or other cryptocurrencies?
Well, I had a little Bitcoin. I had 1%, but that managed to shrink to about 0.6 here in the last couple of months. I haven't added the position. It's the kind of thing I think you need to have a little bit in digital currencies, but not a whole lot.
I have a little bit. I have 0.
Yeah. Okay. I just think it makes.
But Romanians are bullish on cryptocurrencies, Bitcoin, and all this Ethereum, and I don't even know how they are called. We even have a local cryptocurrency, which I don't remember how it is called. Elrond, I think, yes. And I think most of Romanians keep money into cash, so they are good market timers.
Okay.
Into real estate, we have a 96% home ownership rate, which is huge.
Wow.
And this is a very concentrated and illiquid asset, but they somehow feel that they don't see that volatility, on a secondary market. And
you haven't had
the stable cash flow, and do you think, by the way, that this real estate can be seen as a replacement maybe for safe withdrawal rates because of the rental cash flows in retirement?
Yeah, you're talking about directly held real estate. I had clients when I was an advisor who loved real estate and did very well with it. And yes, it can be a good alternative. I think it's a good holding in this environment now. Even a real estate mutual fund or ETF, could do pretty well relative to the market. But for directly held real estate, you have to have a certain mentality. You have to like managing properties. Not everybody likes that. I think it's a good approach for the right person with the right mentality to handle that.
For that person who has that approach and mentality, maybe it could be a diversifier somehow in this risky market environment for at least getting some part of, let's say, stable cash flow, because I don't see many good diversifiers. I mean, okay, you can have some cash as a hedging for corrections and market downturns, but on the long run, negative, deeply, so not the value, but deeply negative returns. Same for bonds. You said in the Rational Reminder podcast that, okay, equities are expensive, but what about bonds? Bonds might be even more expensive than equities.
Yes.
So not a place where you want to be, particularly right now when we have high inflation, right? What else except for private real estate or equity? Managed futures. Unfortunately, here in Romania, Europe in general, we don't have access to such funds in UCITS format. We also don't have access to long-short factor exposure. So JP Morgan just closed its funds, I think, last year because they had low assets under management. So very, very hard. And I even discussed with Nicholas Rabener from Factor Research. He owns this website and makes a lot of research on factors. And he was telling me that even for his retirement portfolio, he doesn't see many good diversifiers and many good options besides equity. So unfortunately, we are kind of stuck between market timing and taking a lot of risks in equities right now. I mean, it's a really difficult market environment.
It's incredibly difficult. And I read articles interviewing some of the top investors, and it's they just pulling their hairs out. They don't know where to go. I mean, look, Mr. Buffett's been sitting on a huge pile of cash, for years now, and he doesn't see fit to invest that because he can't find anything worth. And I think eventually he'll be proved right. But not many professional money managers can get away sitting on a pile of cash like that for such a long time, as he did.
You talk about Berkshire Hathaway?
Yeah, Berkshire Hathaway, which of course, he generates a lot of cash flow from money outside his investment
But
portfolio.
I think they have in absolute numbers a lot of cash on the sidelines, but they also, I mean, in percentages, I don't think it's more than, 20%, or they're still invested with most of their capital, right?
Well, yeah, a lot of those investments are direct, they control interest in companies. And those companies don't trade, some of them, on the market. So he doesn't care about market fluctuations for those investments because they're all private. But I think he had about 140 billion in cash, which is that's a nice little stash, and that's only been increasing,
And I think his partner Charlie Munger was buying Alibaba stock right now. I mean, he prefers Chinese equities because are less expensive. I was looking at Barclays tool, and I think the CAPE for China right now is 13 or at 3 times less than US. And some say that China might be the new US or the new economic force of the world. We don't know, of course. But
who knows? I mean, when you calculate PE ratios for China, you have to be careful about, the integrity of the financial information you're being provided. That's been questioned in the past.
That's true. But I believe that diversification is more useful now than it has ever been. But in the same time, it has lower options that it ever had.
Yes. But markets are cyclical. What looks desperate today in a couple of years can be flipped completely around. And like we went from 2007 was overvalued to 2009, which is cheap, just in 2 years, less than 2 years. That can happen here too. And that'd be very exciting. I love an opportunity to buy things at a CAPE of 12 or 13 or 14. I'd back the truck up,
I definitely agree with you, and I'm waiting for the same opportunity, maybe a one-in-a-lifetime opportunity, why not? But I watched from the distance the debate between Larry Swedroe and Jeremy Grantham. And Larry was saying that just because CAPE is high doesn't mean that equities won't still outperform bonds, because the current price is the best price that the market can have, because markets are efficient. So this might mean, and this also is what Bob Prince is saying right now, that maybe the markets are less risky in a way, and therefore it's normal to have lower expected returns. And it doesn't mean 100% that they will crash. What do you think about this point of view?
I think that's a fascinating rationalization. I think that needs to stand the test of time first before I get enthusiastic about endorsing something like that. I mean, when you're in a huge bull market, as we had here for the last 12 years, a lot of people's inhibitions and concerns and fears just kind of melt away. Stocks have been going up for so long, so consistently, it's hard for them to imagine declining. And then you hit a period like this, and it starts to wake them up. It takes time. We'll see. I don't think markets have fundamentally changed that much because they're based on human reactions, human emotions, and cycles will persist, and opportunities for purchase at good prices will reappear.
So maybe, I don't know, markets tend to be efficient, but maybe not 100% efficient.
No, I mean, take a look. The S&P has dropped 10% this month. How much change has really occurred in the companies that are in the S&P 500? You're telling me that 20 days ago they were worth 10% more than they are now? That can't be the case, So, no, there are periods of time when the markets are horribly inefficient. And I think this is one of them.
Yeah, but I think, I don't know, Keynes or who said that markets remain irrational more than you remain solvent?
Yeah, that's the truth. That's true.
So
It'll drive you crazy.
I mean, this is what some people say. You have to believe in this probability-based approach that investing in the markets for the long term is the right thing to do. And you shouldn't care about valuations because eventually you cannot time the market.
Yeah. Well, once again, it's how you define timing the market. I agree. If you're by saying that you can't time tops and bottoms exactly, but long term for somebody like me who's age 74 is not what it is for somebody who's 24. My time horizon is going to be a lot less. So I have to think in terms of 15 or 20 years if I'm lucky. And 15 to 20 years, markets have exhibited pretty wide variations in behavior. So I still think retirees have to be careful, more careful than normal.
But I think this is also what Larry Swedroe says, that if you have enough that you are happy, you no longer need to take on risk, right? So maybe
yeah, I agree.
I think it depends on how much capital you have and how much cash flows, and then you decide, do I need to take this risk, or maybe I wait for better opportunities?
Sure.
Why not?
I know people who take 1% of their funds because they're so well funded, and the rest they put in CDs and money markets and short-term bond funds. As you say, they don't need to take any risk at all. Maybe they have heirs they want to prepare, for. So I agree with that philosophy.
So these guys, how much do they have in equities?
Oh, they might have 20% in equities, something like that. There's no need really to do more than that. That's all. To generate a 1%, if they need to generate maybe 4% return, 4 or 5, and that's all they need, the equities, to give them that.
Bill Bengen, I would like to ask you, if you had 30 years today, what would have been your strategy?
If I could start, let's say, for 30 years, and what would my withdrawal rate be? Or
no, let's say you are a young man, you have 30 years old.
Oh, you're 30 years old. Sorry.
Let's say both a lump sum of cash and also human capital, and you live in this market environment in 2022. What do you do? Because you're not a retiree, so you don't have to maybe protect your nest egg that much. Would you be more aggressive? And if yes, how much aggressive? I mean, would you cap your equity allocation to maybe 30, 50%, or how much?
Well, I would use a service like InvestTech, even at pre-retirement, which would say you should have 70% of your investments in equities now, which is a pretty good chunk, because normally you'd want to have 100% pre-retirement. In my opinion, you want to have as much as possible because you're adding money and you don't worry if things decline. But you don't. Then again, you don't want to go through a period of time when you lose 50 or 60%. If you can avoid that, you can cut that in half, like Investec has generally done, that's a lot. Everything compounds. So if you avoid really bad results, then your compounding is greatly enhanced.
Yes, and also there is that portfolio size effect. I mean, the loss is much more harmful if you have a big nest egg, as if compared, let's say, to someone who invests 1K per month and has no lump sum. I mean, he basically does dollar cost averaging. He doesn't care about what the market does short term. He may even lower his cost of purchasing those units, right? By buying at better prices. So for him, the risk management might be different.
Yeah. If I was young, though, I'd still probably use some kind of risk management, because it doesn't sit well with me to know that I'm at 40 on the Cape with inflation coming in and tremendously speculative markets. And you just know you're going to take a big hit somewhere along the way. They always do in that environment. So why not pull something off the table, even if it's 20 or 30%, and prevent that capital from being destroyed?
I agree with you when it comes to sequence of return risk. But what happens with the other risk, with the inflation risk? If you stay in cash, you pay a huge premium. In Europe, inflation is 5% right now. I don't know how much is in US. I think 5, 6, or 7. I don't know exactly. In my country, is 8%.
8% for cash?
Yes, in Romania, it's 8% right now. In
many, can you find me a house there? I'd like to move. 8% plus return. That's remarkable.
Yeah, so inflation might be huge. In emerging markets, I think might be even higher. I think in Turkey was 30 or 50%. I don't know. So how do you protect from the other risk, from inflation, if you don't invest in equities?
Very difficult.
You can get treasury inflation protected bonds, but they guarantee you a negative real return. I think in Europe, the tips offer right now minus 1.75% for a medium term holding. So you are guaranteed to lose money.
I'm not excited about tips here. I think they're pretty expensive, Victor, I've enjoyed this, but I need to get on to a doctor's appointment. Can we end that here?
Sure. It was a pleasure, Bill, to discuss with you today. I would like to thank you very much for joining our podcast. And also, I would like to applaud you for all the work you have done for retirees and for your research. I'm waiting for that paper to send me when you have time for your article. And also, I would like to thank all the viewers who have watched our show today. Thank you very much. Have a nice evening and all the best. Goodbye for now.
Thank you, Victor. I enjoyed it tremendously.